One of the most powerful features of Forex trading is that you can profit in both rising and falling markets. When there is greater demand for a currency, its value increases. If you believe a currency pair will go up in value, you would take a long position, which means you're buying the base currency and expecting the price to rise. This is known as going long or taking a long position. You buy the base currency and sell the quote currency. You want the base currency to rise in value, and then you would sell it back at a higher price. On the flip side, if there is greater supply, the value of the currency tends to decrease. If you believe a currency pair will fall in value, you would take a short position, meaning you're selling the base currency and looking to profit as its value drops. This is known as going short or taking a short position. You sell the base currency and buy the quote currency. You want the base currency to fall in value, and then you would buy it back at a lower price. This ability to trade both ways, buying in uptrends and selling in downtrends, is what makes Forex such a flexible and dynamic market.
Let's walk through a practical example of a long buy trade in action. You will learn to identify potential trades in the lessons on strategies later in the course, and we will go through many examples of potential trades. So don't feel overwhelmed, as all this will become second nature the more we go through it together. In this case, you're bullish on the GBP-USD currency pair. Based on your analysis, you believe the British pound will rise against the US dollar, so you want to make a profit by going long on GBP. Remember, going long means to buy the base currency. You've identified a long setup on the 30-minute time frame. A clear candlestick pattern confirms your entry signal. This candlestick pattern marks the trigger for entry for your trade. You place a horizontal line on the chart to mark your intended entry point and check the price on the y-axis. Take a note of this price, which is your entry point, at 1.2727. You will buy at this price. Next, you will calculate your stop loss. This is the point where you will exit if the trade moves against you. You place a horizontal line on the chart and check the price on the y-axis. In this case, you will place it at 1.2699. The difference between your entry price and your stop loss is known as your 1R. R stands for risk to reward. In this example, that would be entry price 1.2727 minus stop price 1.2699 equals 28 pips. Finally, you will define your take profit level, where you'll lock in profits if the trade moves in your favor. This is a simple calculation. All you need to do is multiply your 1R by 2. So 2 times 28 pips equals 56 pips. Now add the 56 pips to your entry price. So entry price is 1.2727 plus 56 pips equals 1.2783. Then look at the right on the y-axis to find the price and place your horizontal line. This will be your sell price at 1.2783. This calculation is known as 2R. In essence, you are risking 1 to make 2. In this example, you can say you are risking $280 to make $560. Your 1R 28 pips is $280, and your 2R 56 pips is $560. With all three levels set, entry, stop loss, and take profit, you calculate your position size and place the trade. More on position size later, but for now let's assume one standard contract, or 1.0. Your trade is triggered by the next candle and you are in the trade. A few candles later, the market hits your take profit and the trade is closed with a $560 profit. A solid result from a well-planned trade. Now, let's take a quick look at the trade metrics behind this setup.
Let's break down the trade metrics from the long trade example we just covered. You entered the trade using one standard lot, which is equivalent to one contract. More on lots shortly. You bought GBP USD at 1.2727. GBP price went up to 1.2783. You then sold a pair back at 1.2783 and got out. That means the price moved 56 pips in your favor. To calculate your profit, we use the dollar value per pip. This simply means how much is one pip worth in dollars. In the case of a standard lot on GBP USD, each pip is worth $10. So, 56 pips multiplied by $10 per pip equals a total profit of $560. In terms of monetary value, you controlled a position size of $127,270. You purchased £100,000 and paid $127,270. Remember, when you buy, your balance is negative because money has left your account. Then, you sold your £100,000 and received $127,830. Now your balance is positive as you received funds for your sale. So, $127,830 you received, minus the $127,270 you paid, made you a profit of $560. That means your $560 profit represents a 0.44% return on investment for that trade. To calculate your return on investment, you simply divide your $560 by your position size of $127,270. It may not sound huge, but remember, this trade took just about 2 hours, and the key is consistency. Over time, small percentage gains add up. Not bad, but hold on a second. But I don't have enough money to buy 100,000 GBP. Can I still trade? Yes, of course you can. Here's where things get more exciting. Thanks to leverage, you can potentially earn similar returns using just a fraction of the capital. You can achieve similar returns on investment with a smaller starting capital by using leverage. Using leverage of 1 to 50, you only need 2% margin to control the full position instead of $127,270. That's just $2,545 out of pocket. Now calculate your return using leverage. $560 profit on a $2,545 margin equals a 22% ROI on your capital. Now we're talking business. In this course, we cover the very basics on leverage, margin, and compounding to help you get started. We explore these topics in greater detail, including how to use them effectively and safely to grow your account in the Forex Trading Advanced course, Level 2. For now, our goal is to help you understand the basics and get started trading with confidence. You can trade £10. With 1 to 50, for every pound you have, you can trade £50. And with 1 to 100, for every pound you have, you can trade £100. So, if you have £100 and you use 1 to 100 leverage, you're controlling a £10,000 trade size. Let's use a real-world example. Imagine a car costs £10,000. You deposit £500 and the bank lends you the remaining $9,500. Trading leverage works in exactly the same way. Your position size is £10,000. Your margin or deposit is £100, and the broker effectively lends you the rest. Now here's the important part. If price moves in your favor, you can make more money. But if price moves against you, you can lose money much faster. This is why leverage must be used carefully and always combined with proper risk management and stop losses. Leverage is a tool. Used correctly, it helps you grow. Used incorrectly, it can destroy an account very quickly. And like we've seen in the previous examples, using leverage you can make more profit with a smaller amount of money. You don't need a large account to start trading.
Let's see leverage in action with a real example. Let's imagine you have $1,000 in your trading account, and your broker offers 100-to-1 leverage. That means you can control a position worth $100,000. Now, let's say you buy Euro USD at 1.1100. The price moves up to 1.1100. That's a 100 pip gain. Scenario 1. The trade goes in your favor. If you didn't use leverage and only traded your $1,000, your profit would be just $10. Remember, with $1,000, you can only trade 1,000 units of the base currency, so each pip move is worth 10 cents. But with 100-to-1 leverage, you're controlling a much larger trade, and your profit shoots up to $1,000. You've just doubled your account. Scenario 2. The trade moves against you. But what if the price moved the other way? Without leverage, your loss would have been just $10, but with leverage, that same move could wipe out your entire account, a full $1,000 loss. So what's the key takeaway here? Use leverage wisely. It can multiply your gains, but it can just as easily multiply your losses. Always manage your risk and never trade more than you're prepared to lose. In summary, the The biggest appeal that Forex trading offers is the ability to trade on margin. Margin trading means you can enter trades that are much larger than your account balance. Even a slight price movement in your favor can potentially lead to substantial profits. However, for most new traders, who often lack experience, that's rarely the case. More often than not, the price moves, but in the opposite direction. Leverage also increases your risk. Losses can exceed your initial deposit if not managed properly. Even small market movements can result in large gains or losses when trading with high leverage. It is crucial to understand how leverage and margin work to use them safely and effectively. Always manage your risk and never use more leverage than you are comfortable losing. Make sure you have a solid grasp of how your trading account actually works and how it uses margin. A lot of new traders do not understand the concept of margin, how it's used, how to calculate it, and the significance that it plays in their trading.
Now let's talk about margin. Margin is the amount of money you need in your trading account to open a trade, and to keep that trade running. It allows you to control bigger trades using a smaller amount of money. This can increase your potential profit, but it also increases your potential risk. So margin is powerful, but it must be respected. Let's simplify this. Margin is a deposit your broker holds while a trade is open. Used margin is the part of your money that is locked in open trades. Free margin is the money still available to open new trades or to absorb losses. And a margin call is a warning that your account needs more funds to keep trades open. When you start trading, you will see these metrics live on your trading account, and this is what you will monitor on a daily basis to see how much money you are making or losing. Now let's look at a simple account example. Let's assume your account balance is £1,000. You use £200 as margin to open a trade. This is the deposit the broker will lock for that one trade. That means your free margin is £800. This is what you have left to open additional trades, and also if you have a losing trade, then this is the amount that will be used up in a losing trade. Equity is your balance plus or minus any open trade profit or loss. Let's look at an example. If the trade is losing £50, your equity becomes £950, and your free margin drops to £750. If the loss increases to £300, your equity falls to £700, and your free margin drops to £500. If free margin drops too low, you risk a margin call, or even having trades closed automatically by the broker. This is why proper risk management, small position sizes, and stop losses are essential when using leverage and margin. Now let's look at a real trade example to understand how margin works in practice. Imagine you have £1,000 in your trading account. You open a trade worth £10,000 using leverage. Your broker requires 2% margin to open this position. So, 2% of £10,000 is £200. This £200 is your used margin. This is what your account looks like. Your balance is £1,000. Your equity is also £1,000 because the trade hasn't moved yet. Used margin is £200. And your free margin is £800. This gives you a margin level of 500%. Now let's see what happens when the trade moves. First, let's see what happens when the trade moves £100 in profit. Your balance stays at £1,000 because the trade is still open, but your equity increases to £1,100. This is your balance plus the fluctuating profit. Used margin stays the same at £200. This is the deposit your broker has locked for the trade, and your free margin increases to £900. This is your account balance minus the deposit plus the $100 profit. Your margin level rises to 550%. Now let's look at the opposite scenario. Imagine you're in a trade without a stop loss. You simply let the trade run with no protection in place. When traders say a trade is naked, it means there is no predefined point where you accept a small loss and exit if the market moves against you. This approach is not trading. This is gambling. And this is exactly why so many people end up blowing their accounts, then going around saying that trading is gambling. The reality is, those traders are only focused on seeing wins. They don't want to accept losses. But that mindset is dangerous, because losses are a normal and unavoidable part of trading. Successful trading isn't about avoiding losses, it's about controlling them. And that's why risk management, especially using a stop loss, is non-negotiable. So in this case, you were in a trade without a stop loss and the trade is losing money. The trade is showing a £700 loss. Your account balance is still £1,000 because the trade is still open, but your equity drops to £300. The £700 loss is unrealized, meaning it only exists on paper for now. At this point, the trade can continue to move further against you, or it could recover if you allow it to keep running. Your balance will not change until the trade is either closed manually by you or closed automatically by the broker due to insufficient free margin. It's important to understand that brokers will not allow you to lose more money than you have in your account. So, if the loss approaches around £900, the broker will step in and force the trade to close, locking in that loss. This is another reason why relying on margin calls instead of proper risk management is extremely dangerous. With the £700 loss, used margin is still £200, and your free margin drops to just £100. That is your account balance minus the £200 deposit, minus the £700 running loss. Your margin level falls to 150%. At this point, you are very close to a margin call. A margin call is when the broker steps in and sends you notifications or emails asking you to either add more funds to your account or close the losing position. If you don't take action, the broker will eventually force the trade to close to prevent your account from losing more than the available balance. Most brokers will automatically close losing trades when the margin level falls below 100%. This is a level you never want to reach. The good news is, you don't need to memorize or stress about any of this. As long as you follow the rules taught in this course, you will never be allowed to reach this point. This explanation is purely for your understanding. Everything in this course is designed to keep you out of the gambling mindset and firmly in the category of disciplined, risk-managed traders. This is the margin level formula. Margin level percentage equals equity divided by used margin times 100. This example shows why risk management is critical. Margin can help you grow an account, but without discipline, it can also wipe it out quickly.